Hey everyone, Matt Stevenson here, President of Allied Wealth. Thanks for joining us again today. Welcome to our YouTube channel. If you like today's content, remember to hit the like button and subscribe to our channel to continue to get our content moving forward. Today, what I wanted to share with you is a recent client story of Bill and Jane Smith. They came into the office a couple of months ago and they had a unique situation that I wanted to share with you that you at home may find relevant. And so one of the first things that we do in building a financial flight plan is we want to identify how your current portfolio is positioned. And this is exactly the process that we walked through with Bill and Jane. And so Bill and Jane have done well for themselves. They're in their late 50s, early 60s. They've saved away about $1.7 million in the nest egg. So they should be very proud of that, to be sure. One of the challenges, though, that we wanted to address with them because of the current environment that we find ourselves in is how they were positioned with the portfolio. In fact, they had had a fairly straightforward approach in saving, as most of us have. A lot of folks are taking advantage of what we call those target date funds. And really inside of those 401ks, what we find is the target date fund is the most common investment tool that people use to save, whether it's those bi-weekly, monthly contributions to build up the nest egg over time. That's exactly what Bill and Jane had done as well. Just sock that money away into the 401k, kind of a set it and forget it approach. Well, inside of the IRAs and 401ks that Bill and Jane had accumulated, they had two different funds, both of which were target date funds. And so here we have the Fidelity 2020 target date fund and the Vanguard 2015 retirement date fund. I'll explain a bit more on how these work and how there may be some adjustments to be made for Bill and Jane here in just a second. But one of the first things that we want to identify is what we call a benchmark. And this will help to explain a lot of the positioning, not only now, but some perhaps adjustments moving forward. When we look to build a benchmark, we can do that along a risk versus return scale. So for instance, that scale goes from bottom left to top right, just like so. So this bubble or portfolio here on the top right would be the most aggressive. Over time, it should get the highest amount of return, but it will also likely have you the most on the emotional and monetary roller coaster over time. On the flip side of that, down here on the bottom left is the most conservative set of investments, which should give us perhaps less return over time, but should also give us a bit more stability as well. And so as we look at this risk-return scale, it also allows us to identify what we call our benchmark. And so our benchmark is our direct comparison for the set of investments that we currently have. For instance, if we were to use our benchmark, say here on the top right, that would be equivalent to tracking alongside the stock market or the S&P 500. That's about as aggressive as we can be and about as volatile as we can be with those ups and downs over time. Now, traditionally, what we do to reduce risk in the portfolio is we add bonds into that mix. So for instance, as we move down this scale, the next benchmark would be what we call an 80-20. The 80% representing the positioning of stocks and the 20% the bond or fixed income portion. As we continue to move down that scale, the percentage of stocks becomes less, the percentage of bonds increases. Many of the folks watching at home may have heard the term a 60-40 portfolio. That's been the predominant mix of stocks and bonds within the nest egg for many of us over the years. In fact, though, when we look at Bill and Jane's portfolio, it was one notch below that in more of a 40-60 portfolio. So as we look here at their current mix of stocks and bonds, which we can tell here from our percentages, where we have about 40% of stocks and about 55% or so in bonds, another 5% or so in cash, gets us to that 40-60 benchmark. So a bit more on the moderate to conservative side of things. Bill and Jane don't like to take a lot of risk. And so as they've gotten closer to retirement, now entering into it in their late 50s, they wanted to be fairly conservative and smooth out their ride with what the nest egg accomplishes over the years. Now, this is going to be very important to frame the rest of our conversation and really identify the ways in which this is currently positioned may not work quite as well moving forward. Now, as we scoot down here a bit, the next thing that we want to focus on is primarily how has this worked for Bill and Jane over the years? And anytime that we measure a mix of investments, we want to keep this idea of time horizon in mind. And time horizon simply means for any investment that I have, how long should I need to invest in that to see the results I'm looking for? For instance, if we track the stock market or the S&P over time, it can take quite a while for this to play out. In fact, market cycles tend to last anywhere from 10 to 30 years in time. No better example of that than since the turn of this century. Since the year 2000 to where we sit today, we've seen two major market crashes, one significant market downturn in the pandemic, and we're right in the middle of yet another downturn here at the beginning of 2022. All of this roller coaster ride with the market has led to success, but it can take quite a while to see those results. And so for that very reason, we want to measure any set of investments over a long time horizon. In this case, when we look at the first row, our annualized total return, or how much growth Bill and Jane in this case have seen per year, we want to measure that over here a 20-year time horizon to really get a good sense of how this has been working for them. And so now over those 22 years of time, Bill and Jane have averaged about a 5.2% rate of growth per year, which is not bad. To compare that to, say, the stock market, the S&P 500 has an annual growth rate over that same time frame of about 7.5% per year. Now, we've already identified that's not Bill and Jane's direct benchmark, but for a comparison, we see that we are giving up a little bit of return compared to the market itself. But when we get close to retirement, that's half the battle. We also must identify the level of risk that we're taking to get said return. And that's where we can go back to high school stats class for a second. And we can actually measure the amount of risk that we take in terms of what we call standard deviation. All that simply means is how far above or below our average annual return the nest egg should move in a typical year. And so it's a measure of risk for your life savings. Here we find that Bill and Jane's risk level or standard deviation is 9.1. Now, so far that's just a number. It doesn't really tell us anything. Again, to draw a comparison to the market, the S&P carries a risk level over the same time frame of about 14% per year. So right away we see two things. We are giving up some return to the market per year, but we are taking quite a bit less risk than the market each year as well. And that aligns more or less with our expectation, being in a more conservative benchmark. There are some concerns here though. As we scoot down to this bottom row, we see that term maximum drawdown. And that's a very important term that we focus on quite a bit with our clients in the office. It helps us to measure our potential risk of loss in the portfolio. Now, while we're going through our working years in our 20s, 30s, 40s, maybe early 50s, we don't necessarily worry about that as much because many of us have the time to make up for that roller coaster that the market can provide to us. But once we get into retirement and we need to use the nest egg reliably as a source of income to partner with Social Security, perhaps a pension, then we must seek more consistency with how the nest egg performs year in, year out, while minimizing the potential for loss. And the reason why this is so important is here. Over that same 20-year time frame, Bill and Jane's potential for loss and what was actually realized on that set of investments was north of 40%. To put that in dollar terms, on an easy math example of $1 million with a 40% drawdown, that $1 million turns into $600,000 very quickly in the midst of a market downturn. So this was somewhat alarming to us in the office when we shared this with Bill and Jane because their benchmark, their level of risk was so much lower than what the market is, yet their potential for drawdown in the portfolio remains quite high. But it doesn't stop there. There are added risks potentially to the setup of Bill and Jane's portfolio that many of us haven't had to worry much about in the previous decades. And for this, I'll scroll back up just a moment. And you may remember from our benchmark conversation that Bill and Jane are fairly conservatively positioned with those target date funds that many of us use, but about 55 to 60% of their nest egg, that $1.7 million, is positioned in fixed income or bonds. The reason why that may be a challenge moving forward is the relationship that bonds have to interest rates. So it's been great to be a bond investor really for the last 40 or so years. Case in point, if we go back to the early 80s, we could get a bank CD or get a mortgage for about 10 to 15%. Now, over the last 40 years, we've seen that number steadily decline to where at the beginning of the pandemic in 2020, we quite literally hit a 0% interest rate environment. Now, we all know when we go to fill up our pump at the gas tank or go to the grocery store to buy our milk and bread that we're seeing high levels of inflation right now. And the Federal Reserve is raising rates, interest rates, to begin to combat that and moderate the amount of inflation that we're seeing. Now, certainly that may take a while to happen, but as they begin to raise rates, and they've already told us they're going to do so, in a rising rate environment, we see that bond values have that inverse relationship with interest rates. As rates begin to go up, bond values underlying those rates will begin to fall, especially in the short term. That adds a lot more risk in the form of interest rate risk to that 60% of the portfolio that Bill and Jane, and many of you, have not had to worry as much about in the last several decades. And so this was one of the main things that we wanted to identify with Bill and Jane, is that even though they seek to be conservative, they don't like to take a lot of risk, allocating as much as 60%, if not more, of your nest egg to an asset category that is set to become riskier and perhaps decline in value for the foreseeable future adds another layer of risk that we can't really see on the written page as of yet. Now, with that being said, now that we have a better idea of how Bill and Jane are positioned with their nest egg, we always seek to put that to the test. And so as we scoot down here, we will find more of our planning process. So this is really putting that financial flight plan through its paces. So we're going to look at not only the positioning of Bill and Jane's portfolio, their age, their goals as far as maintaining the lifestyle over the next perhaps 20 to 30 years without that paycheck, and all of our goals is to maintain that lifestyle and not run out of money in the process. And so when we build out our plans, we see here Bill and Jane's ages. So Bill is 56. His significant other, Jane, is 52 years young. Now, one of the main ways that we stress test any flight plan that we build for our clients is through longevity. So again, to answer that central question of making these dollars last a lifetime comfortably to maintain the lifestyle, we want to ensure that these dollars can last for many years to come. In this case, nearly a 4-decade time horizon till Jane is 90 years young to ensure that these dollars do last when building a plan. Now, Bill and Jane are fairly frugal. They need about $6,000 a month net of tax to fund their lifestyle comfortably. And so as we look at that lifestyle expense on an annual basis, that gives us $72,000 net of tax each year. Now, we've already talked about our ugly cousin in the back room, which is inflation, just a bit. When we look at historically at the inflation rate, it tends to run at about 2.5% to 3% per year. Certainly we're seeing much higher than that right now today, but on average, this is what we typically plan for, is that 3% per year inflation or cost of living bump. We absolutely have to account for this because we know that costs to maintain the lifestyle will rise in the future. And so that $72,000 that Bill and Jane need each year quickly becomes $74,000, $77,000, and so on as the years pass. Now, as we saw before, we simply build in their current set of investments, and here making no changes at all to what Bill and Jane are already doing with the nest egg. So we see our average return there, 5.2%, and our risk level was 9.1. And so what this also does is allows us to build a range of expectations for what Bill and Jane should see the nest egg do in a typical year. And much more neatly than I'm about to draw it, we see what we call a normal curve with that range, but there's some information not displayed on that curve that I want to share with you. So I'm an easy math kind of guy. As we draw our own normal curve here at the bottom, we'll take that return and risk and simplify it. We'll call our return a 5% for easy math. We'll call our risk level a 9%. And so now these two numbers allow us to gauge a range of expectations for what the nest egg should do, both in good and not so good environments. In those good years, as you might imagine, we can add our risk number to our average return, and that gets us a return of 14%. You know what? I'll take that any day of the week. That's not bad. But the market doesn't always function that way. I wish it did. But in those not so great years, we would subtract our risk level from our average return. Of course, 5 minus 9 would give us a minus 4. And so our base range of expectations from minus 4 to plus 14 gives us an 18% range. Now, many of you at home may think that's already a fairly wide range of expectations. But one of the things that we know through things such as our risk level and that drawdown number that we saw previously is that markets can often function up to 3 standard deviations below their average annual return. And so in this case, we simply extend our line downward here, and in more of a worst case scenario then, that would give us about a 31% potential drawdown, more or less aligning with what we saw on the analysis that we did of their current holdings. And so now what we see is quite a wide range of expectations. And one of the main goals that we have with all of our clients, Bill and Jane in this case, is to hone in that range of expectations. Perhaps we give up a bit of the upside potential in those strong years for the market, but in retirement, it is much more about how do we seek to minimize, as much as we can, these down impact years that the market can have to create an environment to remain successful no matter the climate around us. And so now that we've properly framed Bill and Jane's portfolio, here we see the makeup of the nest egg. And so much of it in those tax-deferred accounts. So those would be 401ks and pre-tax IRAs for those of you at home. Here we see of the 1.77 million in the nest egg, 1.3 million of that is in Bill's IRA that he recently rolled over from his 401k plan when he retired. We also see that Bill and Jane have done well to build up other buckets or sources of money. In fact, Bill has $120,000 in his Roth IRA, and so this would be money that you pay tax on the front end. You don't get those tax deductions, but as long as you're 59 and a half years young and the growth in those accounts has been there for at least 5 years, you can withdraw the money from that account tax-free in retirement, which helps greatly to reduce our tax exposure on that money. Now, here he's built $120,000 in his Roth bucket. We also see a third bucket, or simply a brokerage account. So these are dollars, again, that we pay tax on up front, and we pay a, for many of us, lower capital gains rate of somewhere between 15 to 20% in most cases on the growth on our dollars. So in most cases, more tax efficient than those tax deferred accounts like your IRAs. Here they've built up about $350,000 in that part of the nest egg for a total between all 3 buckets of $1.77 billion. Again, they should be very proud of that. They've done very well. There are some moving parts here. We've spent a lot of time already focusing on the mixture on the investment side of the equation, but we also know that Bill and Jane here are fairly young. They've retired early, and so at 56 and 52 respectively, we need to bridge the gap to cover those health care costs, especially until Medicare would kick in at age 65. And this is where it's ideal that Bill and Jane have built up other sources of money. If we tap into pre-tax accounts like those IRAs, before you're 59 and a half years young, you pay our friends at the IRS and Uncle Sam a 10% penalty for early withdrawal. We want to avoid that as much as possible. And so in these early years in retirement, we'll lean more so on these other buckets of money to bridge that gap until 59 and a half, which for Bill is about 3.5 years away. So on the front years of their financial flight plan, we'll actually use the brokerage account, and perhaps if we need to, the tax paid portion of the Roth bucket. Ideally, we leave that there for a filler later on in the plan, which we'll talk about in a second. In addition to the nest egg, later on they'll have those guaranteed sources of income. For many of us, that'll be our Social Security benefit. And here we see that Bill's benefit at his full retirement age, which is 67, is $34,000 a year. Now, you do get a cost of living adjustment. It doesn't quite usually keep pace with inflation. And so here we factor in a 2% bump on that Social Security benefit each year for Bill. Jane was a stay-at-home spouse, taking care of their 5 kids, putting them through college, making sure they're well taken care of each day. And so what she qualifies for is that spousal benefit. So she qualifies for up to 1/2 of Bill's benefit at full retirement age, again 67. So here we have Jane drawing her spousal benefit, 1/2 of Bill's, at 67. That's $17,000 per year, again adjusted for inflation. Many of our better halves, as gentlemen here watching the video, will know that our better halves tend to outlive us by a few years. And so in this plan, the longevity or the lifespan for Bill, we factored in at 85. For Jane, very importantly, age 90. And so a large part of our planning process, again, making sure that these dollars last both spouses, but in particular Jane's lifetime, as she is a bit younger than Bill in this case. And so at age 85, Jane would then qualify for what we call a survivor benefit through Social Security, which is equal to 100% of the benefit that Bill was drawing from his own. And so we combine these guaranteed sources of income to drawing on the nest egg each and every year to fund that lifestyle, that $72,000 a year. And we want to test out in a number of different ways the probability of success of making these dollars last throughout their lifetime, nearly 40 years. And when we look at that analysis, we see that perhaps there's some work to be done. In fact, there's about a 67% chance with where Bill and Jane are currently positioned of making it to that finish line and not running out of money in the process. Now, you may be curious why that is. We saw earlier Bill and Jane have done quite well. In their mid-50s, early 50s, they've accumulated nearly $1.8 million in the nest egg and, relatively speaking, are quite frugal. They don't need $10,000 or $15,000 a month to live on. They need about $6,000 net of tax. One might think that would be easily achievable given their lifestyle needs and what they've built in the nest egg. But for all the factors that we talked about previously, there are some challenges. The main one, as we circle back here, has to do with the return expectations. And so while Bill and Jane like to be quite conservative, one of the things that we must also identify is both your tolerance for risk, what you're comfortable taking as far as risk investing, but your capacity to take risk or withstand loss. We've already identified with Bill and Jane previously that on several occasions in the past, their nest egg as currently positioned has lost more than 40% on a couple of those instances. And so their capacity to take risk may not align with where their current tolerance for taking it currently sits. And so minimizing that drawdown number or loss potential, again, is the central theme here. Again, tying back to the bond conversation though, we see here their average rate of return being 5.2%. While not bad, we also know that about 60% of the current portfolio is positioned on the bond side of the equation. Perhaps the outlook moving forward isn't quite as strong, given what we're facing with a rising rate environment, as it has been in the past in a declining rate environment. And so, for instance, if Bill and Jane, on top of their Social Security benefit, need, say, 3% distribution rate from their nest egg, that $1.77 million, to fund the rest of their lifestyle, that becomes a challenge. If they're getting a 5.2% rate of return, and we also factor in an inflation rate on average of 3% rather, then that means that once we take out money from the nest egg each year and we account for cost of living adjustments each year, they're actually going backwards every single year. And so one of the main adjustments that we want to find here is what level of risk are we comfortable taking? Are there ways to get a better rate of return, perhaps minimize the risk that we're already taking, protect part of the nest egg from the crazy environment that we're experiencing, and most importantly, minimize our chance of drawdown? And so that is exactly what we do in building our financial flight plan. As we scoot down here, we talk with our clients about taking a balanced approach. So making sure that you're properly diversified in the nest egg, minimizing our potential for loss, but how do we balance tactically managing and adapting to our current market climate while also protecting a portion of the nest egg from loss altogether to help create an environment to remain successful no matter the market conditions we find ourselves in. That's the exact approach that we built for Bill and Jane. Let's briefly highlight what that looks like. And so the parameters of the plan remain the same. We still have Bill and Jane's ages here at the top. Of course, we stress test each plan for the longevity of making these dollars last. We still have their lifestyle expenses, that's $6,000 net of tax each year, adjusted for 3% inflation. Here is one of the adjustments we were able to make. And so we always seek to bring value to the table in helping our clients. One of those value adds is, are we able to get a slightly better or significantly better rate of return per year? Here we're able to achieve that while taking less risk. So those are two value adds. The main one, in fact, is circling back to that drawdown conversation. And so if we recall, the drawdown number for Bill and Jane was north of about 40% on a couple of instances in the past. They have identified through their capacity to take risk that they can't withstand that sort of loss and maintain their lifestyle being as conservatively positioned as they are. And so in building this balanced approach, what we were able to do is minimize their drawdown to about 10% from top to bottom. So significantly reducing the potential for loss is one of the main things we seek to accomplish. Avoid putting ourselves behind the 8 ball and get the consistent rate of return and growth that we need. We simply apply that in balance to the plan. Here we see that we're implementing principal protection, or what we call safe money, to a portion of Bill's IRA. In fact, 1/2 of it in this case. So that would be the $650,000. And adapting in a tactical way to manage through these market environments with the other portion and ensure that we have the liquidity or access to money that we need each year in retirement. We combine that with a tactical approach to investing with the Roth and the brokerage account. And that gets us to our total of the $1.77 million. We combine that with our guaranteed sources of income from Social Security for both Bill and Jane throughout their lifetime. And now by that simple adjustment, identifying perhaps some areas of improvement to get a better rate of return, reduce our risk level, most importantly, reduce our potential for loss or drawdown, and shift part of the risk away from this bond environment in a rising rate situation, we're able to increase their probability of success of making it to the finish line from 67% to 96%. And when we seek to build these plans, we're looking for a probability of success anywhere between 85 to 90% chance of success. And so what this tells us is it's entirely probable that Bill and Jane could withdraw a bit more per year in those early or go-go years in retirement and still be able to fund their lifestyle comfortably. Most importantly, any plan that we seek to build for our clients, we need to ensure that there's a basket of resources late in life, in Jane's case, to lean on for those emergencies, perhaps long-term care or nursing home needs, all the things late in life that we will need access and liquidity of our dollars to cover. And here, lastly, it gives us a best case, expected case, and worst case scenario for the dollars remaining in the plan at the end. So this is when Jane is 90 years young. And to us in building this financial flight plan, the most important number is right there. So even in the worst case scenario, if things go quite wrong with the market environment for the next 30 to 40 years in this case, Jane would still have about $250,000 adjusted for inflation late in life to be able to cover those needs and expenses as they come about. So folks, this is a great example of how we build a financial flight plan. It all starts with getting to know you, understand where you are in life, what your goals are, helping you to understand and put to the test your current set of investments, identify with you, are there adjustments to be made to really optimize how that plan's working for you, and finding a solution for how to implement that together. I appreciate you watching today's video. Again, if you liked our content, hit the like button below and remember to subscribe to our channel. We'll see you next time.